Welcome to a video that I like to call the deep dive video, and I want to explain this right off the bat because one of my personal pet peeves is clickbait. My context of deep dive might be a little bit different. What I do every week is I do a number of different videos. I do a video each day, I do a weekly video, I do an intermarket analysis video, and then the fourth video for the week that I do is I go through all the charts that I looked at and I pick out those that maybe I didn't really talk about all that much, because sometimes we can get some insight by even looking at those charts. There are also other charts in this video that are unique just to this video itself. And we just use them for informational purposes. And using that with the other videos that I also post can give us some pretty good insight as to what's happening in the market. This is being prepared for Monday, May 18th. This first chart is a chart of the VIX, but you don't see the VIX on here because it's turned invisible. When the VIX was first created, the idea was to use static numbers. Down here at the bottom is 12. When we get to 12 or below, that shows that there's really no fear in the market. When we get to 20 or above, that means that there's a lot of fear in the market. Well, you can see by this moving average that I have on top here, the VIX doesn't always stay within those nice, neat, static ranges. It's more dynamic. And so I put this moving average on here, which is longer term, to tell us, okay, what is the general range of the VIX? Sometimes it's a little bit higher, sometimes it's lower, sometimes higher again. And now we appear to be setting up more of a lower range in the VIX as stocks have been going up. So we just use this for information. Another chart is we look at the VIX, and there's another indicator that we use with the VIX called the VVIX, or the volatility of the VIX of the VIX. And then I also plot a ratio down below as a general rule. When this is going down, the stock market is usually going up. Well, you can see right now, we've been going up for most of 2024. We are starting to level off. And if we continue to improve in the market, it would stand to reason that we might see this ratio going down, but we're not really seeing it turn down yet. Another measure that I use is sometimes the VIX may not be helping us all that much. It has been lately, but right now, I also have another study called a VIX to S&P 500 correlation. And sometimes we can get some insight from this, and that's in the middle area of the chart. When we get up above this dashed line, that means that the market is getting kind of nervous. We may not even be really seeing that in the VIX itself, but we might see it on this chart. However, now we're getting a very low reading as the VIX has been declining since stocks are going up. And since we're not getting any kind of an extreme reading right now, I haven't been using this chart in the videos. Then on top, we have another type of volatility indicator called the MOVE Index, which measures the volatility of bonds. You can see where that's been dropping off lately. Then we have the VIX, which measures the volatility of stocks, which has also been declining. And we can see at the very bottom the correlation between the two. This isn't measuring what stocks or bonds are doing based on price. This measures what are they doing based on volatility. And this relationship is pretty strong right now, meaning that they're tending to go in the same direction at the same time. And that can be kind of useful to know. Then another indicator, which is kind of like the VIX, is called the skew index, where the VIX uses at the money options to look out to see what volatility the market is anticipating. The skew index uses out of the money options to look out and see what kind of volatility is expected. When we get up into this red area, that means that the market is expecting some kind of a big move. And I've tried to mark the spikes in here and then what the market did after that. And you can't put this like we're going to go down, we're going to go up, because sometimes it does mark a top, other times it marks a bottom, other times it's just a continuation as the market is moving in the same direction. Right now, we're just about in the middle, so we're really not getting any insight from this chart. And we have a ratio between the VIX and the MOVE Index, stocks to bonds, based on volatility. And for all of 2024, we've been going up with the moving average. That's really what I focus on here, is the red line. Well, now as volatility has been dropping, we're starting to see this roll over. And if this continues to fall, that will typically mean that bonds are going up and stocks are also going up. But we've been going up for most of 2024, thus to this point. And we look at a risk on versus risk off measure. And there are times when I show this in every daily video, but for 2024, we're just kind of chopping around. We're coming down a little bit now. When this goes up, that means that more folks are risk on. They're willing to get into the riskier stocks because they give better returns. When this is going down, it's more risk off, and they're getting into more defensive types of stocks because they may not necessarily go up, but they may go down less. And then we see this ratio going down. Well, we are going down just a little bit here, but for most of 2024, we really have just been chopping sideways. And we're not really seeing any convicted move one way or the other with this indicator. So I've stopped showing that in the daily videos for right now. And keeping an eye on where are we in relation to the previous all-time high. This was set, excuse me, this was set in early January 2022. And then we had a very difficult 2022. Finally, we were able to go back and set a new all-time high. We've been falling back lately, but we're within about 1% or so of that previous all-time high right now. But just to measure this, where we closed in Friday's session is 8.39% above the previous all-time high. Technical alerts are put out by stockcharts.com. This is for the whole week, where I go through what happens each day in the daily videos. You can see there's an awful lot of blue or green here. And I say blue or green, excuse me. You know, I test my voice before I do this video. I take a drink of water, everything's fine. And then I start talking and everything messes up. That's the problem with take one videos. I just hit the button and record these videos and keep going. But an awful lot of positive things happened this past week. We did see where the NASDAQ ended up crossing down below 16.3 in Friday's session. But for the most part, we've been seeing a lot of the damage being repaired recently. And that's what I use this chart for, just to see, is there a lot of red? Is there a lot of blue or green? And we're seeing an awful lot of blue or green right now. And that depends on what color you end up seeing here. Stockcharts.com also has another tool that they use. They try to remove the emotion from technical analysis because there's a lot of subjectivity where you put your own opinion into a chart. 10 different people can look at the same chart and come to 10 different conclusions. I know that's really weird. That means you're putting your own opinions into what you see in the chart. Well, this attempts to remove as much emotion as possible and give you more an objective score, 0 to 100. The higher the score, the better looking the technical chart. And I look at 5 indexes. Now, you can do this technical score on a stock, on a sector, on a different index than what I go through. That's a tool that Stock Charts has available to you. But I focus in on 5 main indexes. The S&P 500 is the foundation, the real benchmark for everything that I teach and all the strategies that I implement. But I also keep an eye on other indexes. We have the Dow. We have, of course, the S&P. We have the QQQs, the NASDAQ 100, the mid caps and the small caps. And then I rank them as to what's looking best right now. Coming in first place are the mid caps. And since the end of January, this index has actually been holding up a little bit better. Now, it doesn't really look positive until it gets into the 90s. But right now we're getting a score of 87.3, and that's our top index for right now. In second place is the SPY, which is the S&P 500. It's doing okay. It's at 76.1, and it's been holding up a little bit better. Then in third place are the QQQs. Now, when we're really screaming up and the market's really positive and setting all-time highs, usually it's the QQQs, which is the NASDAQ 100, that is leading the way higher. We're seeing that trailing off a little bit, especially over this past week. We don't know if this is something short-term or if this is giving us a signal that we need to be aware of. But right now, it's coming in third place at 68.5. Then we have the small caps, which are doing better, but they've been range bound pretty much for all of 2024. They come in at 67.8. And then in last place this week are the diamonds, which is the Dow. It's coming in at 65.2. And here's some short-term charts, and this is a rainbow. The different colored lines that you see are moving averages from 10 periods up to 50 periods. And we were coming down and actually dropping below the rainbow as the market was going down. Now we're starting to come up out of the rainbow. And this is turning the short-term trend back up to positive, the longer we can stay above these lines, the more they'll turn up and the more they'll begin to smooth out again, if that ends up being what happens. Then this is an indicator that I developed decades ago, but just in the last few years came up with a name for it. It's called the boom indicator. And this measures how far away is price, either above or below a moving average. You can see on the chart that when we get far away from a moving average, it has a tendency to bounce back. Boom, it goes back to that moving average. They act like magnets or rubber bands here. And I measure a 20, 50, and 200 period moving average. And we can use this like an oscillator. Now, we're looking more positive, but we're not extreme when we measure current price that's above the 20 period moving average. If this keeps going up, we might get extreme positive with this indicator, which can suggest either we're going up too far too fast, or could also suggest that we're seeing really good momentum. We're also crossing above zero and going up when we measure the distance away from the 50 period moving average. And we're also starting to go back up when we measure the distance from the 200-day moving average, and we're above the midpoint. So all of these are positive right now and not necessarily extreme. If they go up into these high areas, then that's when I start showing this chart in the daily videos. Intermediate term is another rainbow, looking a little further out, going from 50 periods up to 100 periods. We're also coming up out of the rainbow. And since this is a little longer term, these lines rolled over a bit, but they didn't start to cross over each other. And again, if we can stay above these lines and keep going up, these lines will begin to smooth out and start to turn up and go higher, if that ends up being what happens. We were really, let me try that again. We were really focusing on the 100 period moving average there for a while. And I say moving averages because I have both a simple and an exponential moving average on this chart. An exponential moving average doesn't treat all 100 periods the same. It weights it closer to current prices, and that moving average tends to move a little quicker, versus a simple moving average where all 100 periods are treated exactly alike. And then there's the debate back and forth as to which one's better. I go ahead and just plot both of them on here. When we were coming down in April, we got just a little bit above this. You could say this acted as support, but we didn't actually come down to hit this. But lately, we've been coming up off of that as we've been going back up. And so I stopped showing this chart unless we start to see some weakness. Then we have a Connors RSI, which is an oscillator, but I typically only use this when we get an extreme positive or negative reading, and we're not getting one of those now. You can see the daily values, they really fluctuate quite a bit, but we don't really see an awful lot of extreme positive or negative readings. Then the percent B indicator, there's a whole book of ways that you can use Bollinger Bands. The way I use them in this chart is when we close above or below the upper or lower Bollinger Band. We're close, but we didn't close outside of this. And this is something that when it happens, it's very rare. I think the calculations that I've seen are that we spend only about 3% of the time extreme, either above or below a Bollinger Band. So once that happens, that's kind of a big deal. Well, even though we were getting close, we're not there yet. And so if we start to close outside of the band, then I'll start to show this chart in the video. Point and figure chart. Had been really focusing on this. I actually showed this a few times over the past week in the videos, but we're not seeing anything new after Friday. Currently, it would be green if something new was on here, and we're not getting a signal that's being drawn right now. But this is looking positive. We were seeing a lot of X's going up. That means rising prices. Then as we were pulling back, we saw O's, and now that we're bouncing back up, we're seeing X's again. So this is positive as well. And then this is an anchored moving average, and I spent quite a bit of time this past week trying to come up with other anchored moving averages, and none of them seem to be all that helpful right now as we're dancing around either previous all-time highs or getting close to all-time highs. But these work a little bit different than moving averages. Where a moving average, like the 100 that I was talking about, it starts right now and goes back 100 periods, okay? Well, an anchored moving average, you start at a high or a low, and then it shifts forward. And this can be a good area of either support or resistance. I have a couple of anchored moving averages from the COVID lows. We're well above that. When we were really coming down in October and we finally hit the bottom in October 2023, we actually breached this a little bit, but the market was able to make a stand right there and then bounce up off of that. And we're far away from this line right now, so there's really been no need to show this. And just measuring, are we above or below the 200-day simple moving average? We're above it, so we're green, and we're 10.66% above the 200-day simple moving average currently. Then we want to keep an eye on the S&P 100, and compared to the S&P 500, the S&P 100 has been outperforming. It slowed down a little bit this past week, but what we're looking for are negative divergences here, where maybe the S&P is doing really well and the S&P 100 is not, or the S&P 100 is doing well and the S&P is not. Right now, they're not showing any kind of real divergence at this time. These are just some measurements that I do, so they could be off a little bit. The lows that we set in October and then where we closed in Friday's session, it's up 21.3% from that low. Just giving us some information here. A long-term rainbow, this goes from 50 periods up to 250 periods. We never really did roll over. We came down inside the rainbow briefly, but now we've come back up out of that, and these lines are still continuing to go up, showing that the long-term trend, for right now anyway, is still intact. A daily special K chart. This is a long-term oscillator, and the reason I don't show this is because we don't get very many signals from it. Once we get a signal, yeah, I'll be showing that in the video. For right now, we crossed over in November of 2023, and we've been above that ever since, so there's been no need to show this chart. Then we have a weekly chart of the S&P on top and the German DAX, which is the biggest market in the EU, in the middle area, and the correlation is pretty strong between the two. The higher we get with this reading, the more one-to-one relationship they have. Now, it's not measuring direction. They both could be going down, or they both could be going up. It just means they're moving in the same direction at the same time. And then this is actually getting a little bit stronger here. Take the US 10-year yield and subtract the German yield, and that gives us an answer, which is positive because US rates are higher than German rates. And then in the middle area, we plot the US dollar index, and then we rank what is the correlation between the two. And this has actually been coming up. So we're seeing the top and middle area actually kind of going in the same direction at the same time right now. And the stronger this correlation gets, we might get some insight, because the dollar going up usually pressures stocks. The dollar going down usually gives support to stocks. And if we see interest rates coming down as well, and the dollar going down, then that together often gives more support to stocks, especially in the environment that we've been in lately. And this is a thing called the Hindenburg-Omen, and the perma bears just love this thing. They even love to mention it when we're getting close to this. This is currently not generating a signal right now. We've had some, and that's when you see these spike ups in the top area here in the indicator portion of the chart. But what has to happen is when you see one Hindenburg-Omen, a spike up, within 20 trading days, there has to be another one. And we had one generated back in February, but then there was not a confirming signal. And now time has passed and this signal's kind of gone away. And so this is not giving us a signal right now. And sometimes this can provide some insight. A lot of times when we see one of these signals, it's right before we see a pretty significant decline. This was the COVID crash right here, and this thing was flashing all over the place. And then we hit some highs in late 2021, and then we went into 2022. So we want to keep an eye on this. I used to dismiss this for a long time because the perma bears are so attached to it. And I'm not a perma bear. I'm not a perma bull. I like to be a perma realist. And so I kind of, anything they say, I kind of am really reluctant to adopt, because they can always, no matter what's happening, it's always bad. But we just want to keep an eye on this for right now. Now, what Stock Charts has done is with this indicator, there's really 3 criteria that go into a Hindenburg-Omen. And the indicator that they have here takes all of those 3 criteria, so we don't have to calculate them ourselves. We just look at this chart to see if a spike is coming up. Then support and resistance. These are some Fibonacci retracement levels. This is calculated from the previous all-time high, and then if we had kept going down, we have the different retracement levels that we possibly would have hit, but we never got that far. If we go up and set a new all-time high, then this chart will be adjusted. And then I was really relying on this. This is a moving average based on 20 periods of the open, high, low, close. When we're going up, this little mini rainbow here often acts as support if we're going up and we pull back. When we were going down and then we go back up, a lot of times this little mini rainbow will provide resistance. Well, we were finally able to break through that, and now the lines are slowly starting to turn back up. So I haven't been showing this chart. I was really focusing on this as we were inside the rainbow. Some broad market measures where you have the VIX that measures the S&P 500, the VIXN measures the NASDAQ 100, and showing how volatility has been dropping off lately. I don't really focus in the middle area because you see all these crazy icicles hanging off a roof. So that doesn't really help all that much. I mainly look at the line chart. And then the financial sector, which is doing quite well now. This is a chart I keep in reserve. In case we really start to fall, this red line could be a pretty significant line of support. The bank ETF, which is kind of starting to finally break out of this range, but it's been pretty range bound going back to December, but it's still in a longer term uptrend. We want to keep an eye on the regional banks. There was New York Community Bank a few months ago. There was Silicon Valley Bank and Republic Bank. That's when you started to see this thing really coming down like crazy. And it was starting to show some improvement. And then right about in here was when New York Community Bank came out and said, yeah, we're having some problems too. We want to really watch this because of this interest rate environment that we're in. Some of the smaller regional banks, they may be under some pressure. Now, there's other people that say, no, everything's going to be just fine. There's other people saying, get ready, it's going to get really ugly. So we don't know. So what we have to do is come to our own conclusion by looking at our charts and then keeping an eye on things and then knowing what to watch for. And on top, we have the S&P, and then in the middle is a QQQ to diamonds ratio. So this is the NASDAQ 100 to the Dow. And they had been going in the same basic direction, but now we're seeing that correlation trailing off. But they're still having a tendency to go in the same general direction with each other, whether it's up or down. The transports have been a real disappointment. That's the red line that you see here, and then the Dow is the black line. In a more solid environment, we want to see the red line above the black line, and we just haven't been seeing that in 2024. And then we look at the large caps and compare them with the small caps. Now, instead of using the S&P, we use the Russell 1000 large cap index, and then the Russell 2000 small cap index. And this is, yeah, it's kind of going up, but it's been pretty choppy lately, meaning that the large caps are outperforming the small caps, but we're not really seeing any convicted move, but it is tending to go higher overall. But I haven't been showing this chart unless it really starts to move significantly. Some rate of change charts, and these are just for information. This is going back 250 periods. So we're going up here on this chart, and this is also based on 250 periods, but going back to 1980, this is also starting to go back up. So longer term, we're still positive. And then we keep an eye on bonds, and I've been bringing a lot of bond type charts and studies into the daily videos where we look at a thing called TIPS. These are Treasury inflation protected securities. When we're in a rising interest rate environment, TIPS outperform 3 to 7 year bonds. Now, I haven't been using this chart because what we're seeing right now is in this chart is we're pretty much flat. Okay, but when you look at the TIPS to 7 to 10 year, that's really moving right now. And so I've been covering that in the daily video. This one's a little more comatose, even though it is going up right now. This just means that folks are concerned about interest rates. We want to see this begin to come back down if the market is feeling better about inflation and interest rates. And then we have the long-term bond ETF, that's the TLT, and the S&P 500. We measure the longer-term correlation between the two, and it's not really significant right now. But in the short term, based on 10 periods, they are tending to go in the same basic direction at the same time. And we look at the QQQs and the TLT, and then look at that relationship where it's kind of going in the same direction at the same time, but trailing off just a little bit. And then we keep an eye on the yield curve. We still have the 10 to the 2 and the 10 to the 3 month. Those are still inverted. And if we kick back over and actually go to an uninverted or regular yield curve, then that oftentimes starts the beginning of the countdown to see if we're going to go into a recession, which is typically about 5 months. Now, we don't know. And the debate continues to go back and forth. Are we going to go into a recession? Or are we not? Now, someday, yeah, we're going to go into a recession. We just don't know when that's going to be right now. And these yield curves have been inverted for a couple of years now. And so we just watch these day after day after day being inverted. And then I have a thing called possible positive scenarios. These are really helpful when we were going down in 2022 because they're good at picking out when we maybe have hit a bottom and are due for at least some kind of a bounce after that. But then these charts are also useful, and I use a lot of them in the daily videos. Well, there's a number here that I'm going to go through now that I haven't been using in the daily videos. This is the percent of stocks in the S&P 500 and where they are in relationship to their 200-day simple moving average. I have another study that's based on this, but this study is developed like an oscillator. When we get to an extreme positive or negative reading, we're not seeing that right now. And when we're above 50, that means that we're more positive than negative. But since we're not really getting any kind of an extreme reading, I haven't been showing this chart. And we do that same basic thing with stocks above their 50-period moving average for the S&P, going above 50 and not necessarily extreme right now. Then to get some more context, we look at the mid caps, which are showing some improvement here. And then we look at the small caps, which are, believe it or not, actually showing a little bit of improvement lately. And then we compare the S&P 500 with the 2-year Treasury yield. Sometimes when this spikes up and then starts to come down, that will give short to intermediate term support to the S&P. Well, the 2-year yield is just kind of continuing to go up. It hasn't necessarily spiked up at this point. So there's been nothing that we're really getting as far from this chart as far as insight. So thank you. I hope you found this helpful. Now, after this, what I'm going to be doing is what I call the what to watch video, where this video was going through charts that I don't really talk about all that much. The what to watch video, I'm going to be going through charts that I'm really focusing on right now. So I hope this video was helpful to you. I hope you have a great weekend, and I will talk to you in the next video.